As part of our mission to take the work out of retirement, let's continue our discussion of cognitive biases by focusing on anchoring, another common short-term mistake that can hurt long-term investor behavior. No, not anchoring, as in mooring a ship to the sea bottom or helming a news show, but anchoring as in relying too heavily on the first piece of information we see. We were a bit surprised to see how prevalent anchoring is as a bias. When you sit down at a nice restaurant and the waiter hands you their wine menu, you will notice that more often than not, there is a $200 bottle of wine on this list. This is because we will anchor our value perception to the high-end wine price and begin to see the rest of the menu as relatively cheap. This phenomenon is known as anchoring and gets us to spend a little more money at the restaurant. Investopedia defines anchoring as the use of irrelevant information as a reference for evaluating or estimating some unknown value or information. Anchoring can be a good thing. We need a reference point to determine fair value for something that we're buying or selling. We must start somewhere. However, our initial guess tends to have an enormous influence on our estimate. It can be used several ways in marketing. Multiple unit pricing, 4 for $20 versus $5 each. Purchase quantity limits, example, limit 10 per customer. Or initial price setting, say the MSRP of an automobile, the list price of a house, or the asking price of a stock. All of these strategies can influence us to buy at a higher price. For investments, market peaks and low points are the typical anchors that people use. These anchors can lead to odd behaviors like selling your winners too soon and holding on to your losers too long. According to the Program on Negotiation at Harvard Law School, anchoring is a cognitive bias that describes the common human tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. During decision-making, anchoring occurs when individuals use an initial piece of information to make subsequent judgments. Once an anchor is set, other judgments are made by adjusting away from that anchor, and there is a bias toward interpreting other information around the anchor. For example, the initial price offered for a used car sets the standard for the rest of the negotiations, so that prices lower than the initial price seem more reasonable, even if they are still higher than what the car is really worth. Let's say you bought Facebook stock on January 26, 2018 at $190. It falls to $172 on February 8th. You say to yourself, man, I made a bad investment, but I think it's still worth $190. As soon as it gets back to $190, I'll sell and invest in something else. You continue to watch the stock daily as it starts to run back up. On Monday, February 26, it hits $185. You're starting to feel a little relieved because it's closer to your $190 value. It falls again to $176, then rises to $185 again on Friday, March 16th. You're still waiting for it to get back to its $190 value, so you hold on. Then some bad news comes out, and the price drops to $152 at the end of March. Now what do? On the flip side, another investor saw that the price had fallen from $190 to $152 and assumes that the stock is now undervalued. They purchased the stock even though some business fundamentals may have changed. The company may have lost a major client or be facing regulatory hurdles or product development issues, and the new price reflects the current value, not the intrinsic value. If the price rises back up to $200, they may quickly sell the stock, since it has surpassed the prior anchor, even though the stock might continue to go up from there. Realtors use anchoring to set home prices. By setting the initial price high and then dropping it, they get us to value the home based on their initial offer instead of the historical research we've done on the fair value of the property. Some investors anchor their risk tolerance to the market environment they observed as they grew up. If you grew up in the 80s and 90s, it seemed like the market would always go up. If you watched your parents go bust 2 times in the 2000s, you might be a bit risk averse. You've anchored to the idea that the market is volatile and you'll lose all your wealth. When making investment decisions, we like to analyze a large amount of data to determine probabilities and to carefully set our reference points for fair value. Asset classes can and do become overvalued, markets move cyclically, and investment returns regress back to their means. Having a better understanding of behavioral finance can help us manage our thoughts, feelings, and actions surrounding investing. By choosing our thesis and letting us take the work out of retirement, investors are making a smart choice and taking the emotion out of investing.